Sunday morning, good morning, happy Memorial Day to all the MMTs, new MMTs that are present, our MMT Worldwide Network. International people are very important to us, and we're going to be talking about the S&P 100, and it's going to be a monthly chart. And we're going to go through the S&P 100, 500, the S&P Mid Cap 400, and S&P Small Cap 600 to start with, and then we're going to branch out from there. And what I will tell people here, these are the stocks that happen to be in here. So it's the top 100 companies in the U.S. that are based on market capitalization. And that's how they make these things up. So there's lots of diversification in here. There's lots of good stocks in this S&P 100. A lot of money goes into the S&P 100. Lots of fund managers park money there for years as a safe haven or to handle volatility because they feel, well, the company's going to be here in 20 years. It's really scared money at work. One of the things we're going to talk about here is how do new MMTs understand the public model of what people are going to look at when it comes to time to take profit. Now, I will tell everyone very clearly that when I go over here, back on 10/1 of 2007, this percent DS is a standard indicator that people use for overbought and oversold. Now, you're going to notice that at the peak of a rip-roaring market that we had before the financial collapse, that this here reading was at 89.07% on a monthly. They do have these same readings on weekly and dailies and lower time frames. However, I will tell everyone here today that this peak right here, this peak was 92% in the month of April 4/1. The monthly chart becomes completed at the end of every month. That means that that reading is finally final. Now, granted, in the S&P 100, we've had 1, 2, 3, 4, 5 monthly buy signals. You can see that standard technical analysis before this ever moved to a monthly sell signal where people started getting off board, look at how much of the move happened from the top over to here before it would even signal people to do that. Well, we're using standard chart today, not the MMT platform. MMT platform, everyone knows how accurate that is. The thing that we're going to show is in the S&P 100 on this monthly level, we had a little blurb back over here on 3/1. Because we came down, we hit these monthly moving averages because it does have a monthly buy signal that they come down and they bounce like rockets, and then we made another higher high. Now, let's blow up this part of the chart only so that it's very, very, very clear here from the bottom of 2010 last year when we called for this correction and we could not break it. We still could not break it, but the monthly highs were getting higher here, and then we burned all the way to this current level of this monthly May reversal. Now, when you're at a level, and let me be very key specific, this was 92.77%. Big money is going to say, well, hey, it's time to sell because it's extremely overbought. Now, in the S&P 100 itself, it's called the S&P 100 Index, the OEX.X. The leadership stocks in here that created this exuberant monthly overbought scenario that you would be lucky to see in a ripping, roaring bull market, let alone you would have to have a ripping, roaring bull economy to have these kind of readings. You can tell the exuberance, irrational exuberance with individual players in the market all crowned up and buying up here. This is a monthly reversal. June is going to start on Tuesday, which will be a new month. We'll be looking for distribution is that overbought bull cycles, because it's a bull cycle run, they have to come back down to test these moving averages. Okay, what used to be resistance, and these are significant moving averages up here, folks. Just to give you an idea here, a 50-month moving average is this line, a 10-month moving average is the aqua blue, and a 100-month moving averages. That's open, high, low, close price for 100 months. And basically, the bigger crowd is going to look at it. We have a distribution right here, right now. And you will notice if I take this body, the red body is bigger than the previous green body. Yes, each time they bought the dip within the 2011 corrections that we had here. This correction here was in 3-1. They came all the way down, but you had a big buy that came all the way back up, and we did make that higher high. Now, this is a classical monthly reversal that's extremely, extremely overbought. It's not as overbought as it was. It's 90.65. It's not quite as overbought. But let me tell you, on these monthly readings, my friends, when this green line, that's that percent DS, that's this column right here, when that crosses over the slow percent DA, you'll start to see more selling. And the key is always, MMTs, is understanding which one of these culprits in here are going to be part of the leadership down. You know, we know that Google was part of it. There are stocks in here that will correct because you see, all of the stocks had to make great moves in order to get this to exuberant highs in the S&P 100. What we're looking for in the month of June is if we start on a weekly level and a daily level with gap downs, and we get a gap down below this bottom here and it becomes new resistance, that means that in a bull rally you would come down and test these moving averages. If this is going to be the case once we start the month of June, which is not that great of a month, so you're going into one of the months that are not favorable for the bulls, and that's the month of June, before we go into the earnings season in July of 2011 again. These irrational overbought levels do not create long-term buying opportunities for bulls. It's just that simple. Know when to sell. You've got a correction. The correction started right here in the month of May. We're going to continue to watch these monthly charts and all of these key indexes. So we do have the monthly reversal that we called for. We're going to see if we can come down in the month of June, and how nasty if it gets or doesn't. It doesn't matter to us, but we need to come up. We need to come down and test these monthly moving averages. We need to set up buying opportunities. Stocks, those individual stocks in the S&P 100 have limited upside because you're too overbought in the monthly index here. So you're limited, the upside is limited, and the downside is very, very long to the downside. I mean, you're going to come all the way back down here and test these. We'll find out. I'm just letting you know that the upside is limited, meaning that when you're buying at exuberant tops in monthly charts, the individual names that make up the index on the S&P 100, they're also overbought. They both go hand in hand. And we've been shorting all month of May. That's the S&P 100 large cap. We'll be watching the month of June. We'll be watching that we take out this greater than, just like you would. So we're looking for a monthly bar that would gap below, like it did over here back in 2010 when we put in a bottom, and this is what a bottom looks like. Okay, but you got to remember that even at these highs here, even at 81.35% on a monthly chart, is still considered an overbought zone. You get to 92 here and 90. The new people in the school today are really going to find out throughout their first month here is all of this is going to come very clear to you. And we're going to move forward into the S&P 500. The same rule is going to apply of identifying that the indexes, the indices here, are so overbought that trades to buy and hold, your upside is very limited. Your risk-reward ratio is very limited. Your upside it's limited because you have to correct. And you will.